look at your investments from a total balance sheet methodology. I find young people love to borrow money and then disregard that on their balance sheet, and they look at their $50,000 brokerage account and pound their chest as to how wealthy they are, completely not realizing that they have $50,000 worth of accumulated debt on their credit cards that they're being charged 18% on, and the car that they bought on leverage. They borrowed the money and it's going to depreciate. So another insight that goes with that is don't borrow money for a depreciating asset. Borrowing money for a house, that's fine. Borrow money to start a business, that's fine. Borrow money for anything that will prosper you. But when you borrow money for a vacation, oh my gosh, the math on that is terrible. You borrow money for a motorcycle or a car or whatever, that needs to be paid for with cash. And so that would be the insights that I would give to somebody young.
Hey, it's Rocky. Welcome to Richer Soul. Today's guest is Gil Baumgarten, who's going to pull back the curtain on the investment industry. Imagine it's 12 months from now, and you've achieved your major life goals. How does it feel to be in the best shape of your life, to wake up energized, excited about the day, to have great relationships and friends who support you and propel you forward? How does it feel to have an excess of money, to be able to make the choices you want, to be fearless and open to trying new adventures? Imagine being connected to the universe and it providing everything you desire. It's possible over time, and your past does not dictate your future. The only thing holding you back from this vision is you. It's time to take control of our thoughts and use them to our advantage. Welcome to Richer Soul, where we achieve our dreams and create harmony to health, wealth, relationships, time, and spirituality. If you have not had a chance to listen to episodes 1 through 9, I encourage you to go back and listen to the framework behind Richer Soul and how to create the life of your dreams. You can also find all the show notes for this episode at richersoul.com. Today's quote is from the Dalai Lama. Judge your success by what you had to give up in order to get it. People always look at success and don't realize the price someone had to pay for it, or they're unwilling to pay the price needed to have what they dream of. Remember, every year at the beginning of a sports season, the professionals go back to training, to learn, to practice, to improve. When do you do that? It takes a lot of perseverance and grit to achieve greatness, and we're going to chat about that today and how it applies to you and your kids. Before we do, let's review last week's action step, which was to go look at your last credit card statement and ask, what does this tell me about myself? I do this on a regular basis. We see where our money flowed and we decide if we like the flow or we want to change it. It's quite enlightening for people who've never done it before, and it will show you what you value based on where you spend your money. Speaking of numbers, I'm reading a lot of books on company financials, and I still can't get over how many business owners, just like people, have no idea what their finances are and how to figure them out. How did we get to such a place? I believe people should run their personal finances just like a business. And of course, businesses have to run their finances well too. Once you figure out your numbers and your lifestyle, you can use the 4% rule to figure out how much passive income you need. What I mean by that is if you figure out that you need $10,000 a month to live on, the 4% rule will tell you that for every $1 million you saved, you have $40,000 in income. So to get to $10,000 a month, you need $3 million saved, which at 4% gives you $10,000 per month to live on. Now, this number is inflation adjusted, so every year it will go up with inflation, and it guarantees that with about 95 to 98% certainty, you will not run out of money throughout your life. And so that's a good way to think about it. Today, we're going to talk about money and how the investment world works. Our guest is going to share the behind the scenes, and I encourage you to understand how to invest in a way that ensures you build wealth, not building wealth for the people you're investing through. There is so much bad information out there, and I'll be honest, I fell for some of this. It's a lot harder than you think to keep up with the ever-changing economic climate, and hopefully we can shed a little bit of light on that today. Gil Baumgarten is one of the nation's top financial advisors. He's the founder and president of Segment Wealth Management, an RIA financial advisory firm. Since its inception in 2010, Segment Wealth Management has grown to a top 10 firm in Houston, as recognized by the Houston Business Journal, with over $1 billion in client assets under advisement. Gil is also a 9-time recipient of the top 1,200 financial advisors distinction and has been ranked among the 35 best advisors in Texas by Barron's. Distinctions aside, Gil's affinity for precision and detail reveal itself in his daily life as well. He's an avid outdoorsman, avid winning woodworker, and attentive family man, friend, and colleague. Let's meet Gil. Welcome to Rich Your Soul, Gil Baumgarten. It's great to have you join us today.
Thank you. Glad to be here.
And I'm excited to learn from you today. We like to start at the beginning. What was it like when you were growing up, and how much did your family and school teach you about money?
Like many advisors, I grew up in a situation where my family had some financial difficulty when I was a teenager. What I have found through lots of research that top performing advisors tend to get into the business from the school of hard knocks rather than having been grown into money. And so I learned a lot about money from my wealthy friend's father, who was a very prominent orthopedic surgeon here in town. Although I didn't have good coaching from my family itself, he was almost like the Rich Dad, Poor Dad book. I experienced that. So that's generally where I learned about money.
And I was going to say that. So that sounds like the Rich Dad, Poor Dad. So what were the lessons that Rich Dad and Poor Dad taught you?
Oh, that proper investment success comes from taking risk, not avoiding risk. And a proper perspective about giving money and being generous is not something that I grew up with. And maybe it's just because my family didn't have the ability, financial wherewithal to be generous. But I find in my practice after 37 years, there's a huge connected link between generosity and a proper perspective about risk. And people with a generosity mindset normally approach that from a position of abundance as opposed to a position of scarcity. And scarcity is what the aspiring wealthy tend to have as their mindset, whereas the wealthy have abundance as their mindset. And when you hear the term, the rich always get richer, well, that's the heart of the matter right there. The rich get richer because their understanding of engaging risk as part of their portfolio, and they're willing to endure the downside that comes from that. Whereas the aspiring wealthy tend to engage risk only when they think it's going to go well for them. And when it doesn't go well for them, they disengage from the process, which only assures a failed investment plan.
And so this is kind of a similar quote, but it's like, you don't fail, you give up.
That's right. And at the wrong time. And so if you happen to get really lucky that you engage with the process randomly and you just happen to have a great outcome, well, then you're liable to stick with it over a longer time period. But sooner or later, a big downdraft, a 2008 kind of meltdown is going to cause many people to recoil. And the timing of that recoil is always at the most inopportune time. So you just have to engage with risk with the expectation that it's going to happen. And buying the dips mathematically has always been a fantastic strategy It just may not be immediately profitable. It would always eventually be profitable.
I know 2008 caused me to recoil.
Yeah. Yeah. And you probably still suffer the consequences depending on how you re-engaged with the process.
So I'm the kind of person who doesn't recoil 100%. I do things in percentages.
That's helpful.
Yeah. So it caused me to lose a ton of potential gains. Had I not done anything, I would have been much better off.
Yeah, most people would.
And even our current market situation, similar situation, but we'll talk more about that later. Just out of curiosity, how much does grit matter?
Grit? It matters a lot. Another word for grit would just simply be resilience. And that is the willingness to withstand a setback in the pursuit of your long-term goal. And in my book, we write about the brokerage business and I was in the brokerage business for 25 years and have been a fee-only fiduciary for almost 11 years, running that business as a investor advocacy business, if you will. And I did a stint at one of my former firms where I went into branch management as this promising young advisor 4 years in. So in 1989, I was offered the position at what was then Shearson Lehman Hutton to become a branch manager trainee and learn how to be a branch manager. I subsequently learned that being a branch manager for a brokerage firm is probably the worst job on Wall Street. And I decided to exit and go back to being a broker. But in that 2-year stint, one of the tasks that I was challenged with was to interview the top 100 advisors at the firm and ask them a string of 20 or 25 questions and put it on a giant spreadsheet so that would help with recruiting in the future. We'd know what we were looking for. And grit was the number one thing that determined whether a person would be a top producing broker. And that grit was commonly derived from tough financial circumstances in the family as a teenager. And that would drive someone to say, which I said to myself, hey, if it is to be, it's up to me. And I had to learn that I was either going to have to accept defeat or I was going to have to figure out a way around it. And so that is a defining characteristic in much of success of life.
So that kind of brings up a question, as parents, we don't want our kids to have to suffer setbacks.
Right.
But if they don't suffer setbacks, then how do you build grit? How do you build resilience?
That is a spectacular question and a wonderful and insightful observation that many parents never get to because they prioritize making their children's lives easier as opposed to giving them a taste of that. And frankly, I struggled with it too. I recognized it, and I set up some exercises within my family to deal with those situations. My son, who's 31 years old and extraordinarily financially successful, harkens back to when he was a 16-year-old, and I bought him a 15-year-old Chevy Blazer from a friend who had already recycled it with his 3 children, and it was a total jalopy, and I think I paid $500 for it. And he pulls up to a party in the fanciest part of town, and it just happens that the parking place that he finds is right at the front door of the house, and there's a bunch of kids standing outside. So he pulls into the parking place in this $500 jalopy, and when he opens the door, the inside door panel of the car falls off and drops in the gutter. And he goes back to that scenario of being totally horrified in front of his friends as the catalyst moment where he decided he was going to be financially successful and he was not going to be driving a jalopy like this.
And sometimes you just have to do that. Or were there other things that you did to teach your kids about money?
Oh my gosh, yes. I wish that I had my daughter here with me. My daughter helped me write the book. But one of the other things that my older son also experienced was that he had decided when he was about 15 years old that he loved to drive and he wanted to back my wife's car out and move it in the parking lot. Excuse me. And when he backed the car out, he didn't notice that there was a pole behind him, and he backed the car right into the pole. And so that did like $600 worth of damage to my wife's car. We got it repaired, and I told him he was going to have to pay for that. And so I arranged for him to have a summer job as an intern with a Christian camp in Central Texas. And they paid him. I told them that I would have him work for them for 3 weeks and that I would pay him out of my own pocket the $600 that I needed him to earn. And they were fine with that. So he gets home and he said, well, I hear that I'm going to make some money from this. And so I had 6 $100 bills in my pocket, and I reached my pocket and pulled them out to pay him for the work he had done at this camp. And then before he could blink, I snatched them right back out of his hand again. And I said, that's the $600 that you owe me for repainting the back of Mom's car. And so he also remembers that as a defining moment when, had he not been able to touch the money, he's not so sure that he would have felt the loss in the same way. So
boys and girls are different.
Oh, yes, they are.
So did you do things differently with your daughter?
Not a lot differently. She has been a great employee for me. She recently got married, and they're getting ready to move to Boston. Her husband got into business school. And so we were just sort of negotiating over some final elements of her writing the book for me. And she's always trying to renegotiate, better terms for herself. So she is a very effective negotiator, which also is a very important skill in life. I'm surprised that negotiation is not taught in college, but it really should be. The skill of being able to ask for something more and negotiate for something less, and all of that trade-off is a very powerful negotiation tool. And one of the most powerful methods that I've ever learned by reading and hearing the thoughts of other people is that it's really easy to let somebody else make the first offer. And it is also easy to simply ask them, is that the best you can do? And just those simple words is a very casual way to negotiate for better terms. And because the way it's worded, your opponent in this negotiation is very inclined to give you something better, and many times the best that they can do. So it's a very effective way to get more out of every transaction.
So I've heard that same term used when people do reports and when they make contracts and so forth. It's the same thing. Even with kids, they hand you their book report and they ask you to read it. And before you even read it, the first question is that the best you can do? And that you don't even have to read it at that point. The kid takes it back.
I'm going to go rewrite it, Dad.
and literally, I've heard the story where the kid comes back, or even the employee comes back, and it's the same question again.
Yeah.
And it might happen 4 or 5 times. And when the person finally says yes, they go, okay, now I'll read it.
There you go. Yeah, I like that. That's a very good technique.
So that definitely does work. And that's awesome that you've got your daughter involved in your book writing as well as your business. My daughter helps me out as well. We'll see how things continue once she graduates from college. But
well, good luck.
So far, so good. Well, it's funny because when she went into college, she went in for a certain major. And now that she's on her way out of college, she's like much more interested in what I do.
Mm-hmm.
And sees that because we've spent our whole lives teaching them about money and finances, that when she went to college and she started looking around, she started to realize how big of a gap there was between her skill sets and everyone else's. And so now she's starting to think, I can make a business of this. And she's also starting to realize how much things cost. And she's starting to feel it viscerally because she's paying her own bills. So she knows what it costs. And
unfortunately, a lot of people don't give their kids those lessons until they're 25 years old. And many times too many of their thought patterns are already in place. So I think people need to be really conscious of that when their kids are 5 or 8 or 10 or 12 years old. It gets harder to fix that the longer time goes on. So kudos to you for recognizing that.
Well, we knew it early. As immigrants, you kind of saw the patterns.
Yeah.
And so you knew what the outcomes were. And when I was young, my dad would always tell me, so-and-so did this, and now their kids, and this is going, thinking back, this is going back to like the 70s and 80s. Their parents are super wealthy, but their kid's blowing $5,000 a month at the bar, which today would probably be like 30 or 40,000.
Yeah.
And the parents don't know what to do with their kids. And so not good.
Yeah, not good.
So we're here to talk about your book. What inspired you to write the book, Foolish, How Investors Get Worked Up and Worked Over by the System?
After 25 years working for a brokerage firm and 10 years out on my own as an independent advisor, I just see how the odds are stacked against investors in lots of ways, and it's stacked for investors if you do things in a particular way. And that behavioral shift normally comes from the wisdom of doing things incorrectly and figuring out on your own, how could I have approached this differently? In the book where I quote an old friend of mine who told me that knowledge comes from experience, but wisdom comes from bad experience. So I'm really just trying to take 35 years of bad experience and distill that down to philosophical alignments that people can find a cleaner path to execution. And so those observations really, through my lens, come in two forms. The first form is how Wall Street operates, and especially how it operates in the darkness and the way it creates unseemly situations for clients that you just kind of, as a broker, you just kind of get used to it. But as a fiduciary, you kind of take a step back and go, wait a minute, this isn't quite kosher. And so there's some of that not kosher behavior that we talk about in the book. We talk about stuff that's just, I don't want to call it unseemly, but there's monetization of parts of the relationship that clients would probably be offended by if they knew was happening, and how dangerous that can be, and how that type of thought process to fit into that creates negative tax environment and other issues that clients have to wrestle with. And if they're not paying attention, they may wake up 20 years from now and have the head slap moment where they go, oh my gosh, my approach has been all wrong. So I'm trying to tell them about that now. That would be the first half of the book. The second half of the book is really about how behavioral issues that people have, the bad dynamic that they have with their money. It could be idolatry. It could be just protectionism. It could be the scarcity versus abundance mentality, fear and greed, bad decision making, bad timing, what you feel victimized by. All of that creates baggage that we have to wade through. And if I bring it to the surface and talk about it and kind of give people tips on how to correct that, I think a lot of people are going to identify with, oh my gosh, oh my gosh, oh my gosh. And hopefully they'll get something out of it.
So I'm going to take a step back to something you said early on. To me, real wisdom is learning from other people's mistakes instead of having to make them yourself.
Well, hopefully I'm giving everybody that opportunity.
And that's exactly what I was going to say. If you want real wisdom, you can go out and lose hundreds of thousands or millions of dollars in the market like I have, or you can learn from our mistakes and not make them yourself. And then you don't have to pay the price for that. But that's a hard thing to do sometimes, is to...
Well, just imagine the catbird seat that I'm in, doing business with hundreds of people that have hundreds of millions of dollars. I see these processes repeat themselves over and over again. Conversations repeat themselves. The situations repeat themselves. And so I am in the catbird seat to see how this stuff plays out, and then give people maybe some insights about ways to address it.
And it almost becomes rote in the sense of you're like, oh, yes, that one again. This is what we're going to say because I've heard it 100 times.
That's exactly right.
It's constantly like that. I think one of the biggest problems that occurs is a lot of the people selling products from Wall Street are salespeople. And quite frankly, I find a lot of them don't even understand the numbers behind what they're saying. So they're not trying to be evil. They're just told, hey, this is the best product, go out and sell it. And they're only hearing half the story.
Yeah.
And so they go out and they do that. And let's face it, we are all out selling for ourselves, looking to make a buck for ourselves, regardless of where you sit. And so they're doing what they think is right, but may not necessarily be right. So let's dig into that. What are some of the things that are kind of going on behind the scenes that people are not aware of that are essentially robbing them of their wealth?
Well, fees and expenses are one issue. I think what your observation is correct. And I think it's not just in the brokerage business, it's in lots of lines of work. But people aren't always intellectually curious about, how could I make this better? As opposed to a common way to envision this is that the brokerage business can be much like a rent collection business. And many people just want to get in and collect their little piece of the rent. And the brokerage firm provides me a platform to produce that. And it's not all bad. You know what? I lived in that world for 25 years, but I was a lot more intellectually curious than that. And it took me a while to figure out what would really insightful policy look like, especially for the area of the marketplace that I really wanted to thrive in. And that's in the $5 million and up clientele. And what has evolved is really a $25 million and up clientele, because the way we do things is the satisfaction of what would intellectual curiosity look like if it were turned into investment policy. So, but I do think that fees and expenses are a very big part of the equation. If you were to ask somebody what they are paying, they would either be honest with you and tell you that they don't know, or they would make up a number, and that number would be extraordinarily low because they don't really even understand how it's being computed. People also have a bias towards believing that if a deduction is not on their statement, they cannot be paying a fee. Well, let me explain to you how that works. When a mutual fund declares its net asset value at the end of every day, the annual fee has been deducted the night before. So that the net asset value per unit of that mutual fund reflects the fact that a cost has already been withdrawn, and it's not going to show on your statement. It's only going to show on the disclosure document known as the prospectus that nobody ever reads. And so the friction from that is a very favorite place of Wall Street to embed costs, because clients aren't intellectually curious, the brokers aren't intellectually curious, and nobody has a real grasp of how much money is really involved. The stock market's only going to produce a 8 to 9% return compounded over time. And if you're giving up 200 or 300 basis points, or a third of your return to fees, which is more common than you would want to believe, you're just not going to compound to the same number. A 1 percentage point difference between a 7% rate of return and an 8% rate of return compounded over 30 years on $1 million is $1 million. And so that being the case, people spend a lot of time trying to figure out how to get an extra percentage point of return. They're going about this all wrong. I could guarantee a reduction in cost if it were ferreted out just correctly, by the fact that I could reduce expenses by 1 percentage point in a lot of cases. So it's just people pursue the wrong thing. There's a lot of sense of self-satisfaction that we get from outsmarting everybody else, when it's a lot easier to outsmart them all simply by not choosing to pay the fee in the way they want to derive it. And also those types of services that come with those increased costs also have tax friction that come with them. And that tax friction is very much underestimated. If I can defer those taxes on that extra $1 million for 30 years, I can add another $1 million. So it's just $1 million upon $1 million, starting with $1 million. If you're looking around the edges for where the leaks are in your boat, it's a lot more profitable to be spending your time doing that than trying to adapt your investment policy to figure out how you're going to gain an advantage in the marketplace. Gain your advantage over the marketplace. So that's essentially what we do philosophically and the underpinnings of the book.
That reminded me of a phrase that I used to hear as a kid. Curiosity killed the cat. And when you talk about intellectual curiosity, when I worked in corporate, that was not rewarded.
Yeah, that's correct.
If you start asking questions, you quickly are shown the door.
That's right.
And I think that's one of the underlying problems that people have to face is the people who want to do what's right don't have incentives always to do it, and they actually have disincentives towards it.
Well, so in the brokerage business, I found that I would have these interesting conversations with my boss, and he and I clearly weren't even in the same business because I was trying to build an advocacy mindset looking out for my clients. And he straight up told me, man, you work for the brokerage firm. You don't work for the client. And I couldn't even believe that he said that. And it made it clear to me that I was, despite the fact that I was, in the top 5% of all the brokers at my firm, I managed to do that with an advocacy mindset. And I found that the maze that they wanted me to route my clients through was just something that I didn't want to participate in. And they didn't mess with me much because I had a big book of business. But I just determined that it would be so much more efficient for me to move that business onto an open architecture platform and strive for advocacy every day. And so that kind of drove me into the fiduciary side of the business.
And that kind of brings up a quote from the book, which kind of speaks to this. And I don't think people realize that the brokers think this way. And the statement was, do what's profitable for us, and it will be profitable for you. In broker vernacular, they must be constantly thinking of one question. What's the yield to broker on this?
That's right.
So as a salesperson, if you've got 10 products to sell, you're going to sell the one that puts the most money in your pocket.
That's right. Yeah. Now, that's not to say everybody does that. And it's especially hard on the young advisors that are trying to build a practice. And, they get $10 million of client assets under their belt and, they have to make a living. They're going to put a lot more pressure on those clients than somebody with $100 million worth of client money. And the bigger your practice gets, the more advocacy minded that you can be, even on a brokerage platform. But the system is built not to reinforce that at the brokerage firms. And you do, in fact, have to think, how am I going to get paid on this? And there's several conduits inside of the brokerage firm that you're going to be compensated to walk your clients down this particular corridor. And I liken it in the book to a pinball game. It could also be viewed as a maze. They want the clients marched in a particular way, and the brokers who cooperate with that are going to get paid well. And if you don't cooperate with that, they're going to change the way they pay you to disincentivize you towards the behavior that you are exhibiting. So those are what led to difficult conversations between me and my boss. So
and that's how
it works.
Yeah, I knew that. I knew that with Wall Street. It's one of the reasons that early on in my career, I just made the choice that I am not going there because I'm not selling crap to my friends and family or anybody else for that matter. It's just I couldn't live with it, and it's unfortunate.
Well, it's not all bad. There are shades of good parts of that system, and there are people who, like me, try to do their best within that protocol. And frankly, given how poorly the odds are stacked against an investor who embarks out on their own and just buys mutual funds willy-nilly, even a broker who is inside of a firm that incentivizes them to do things that are less than optimal for the client, they're still probably going to way outperform somebody who's going it alone. Not to mention the person going it alone is responsible for all the anxiety over what decisions I have to make, today or tomorrow. But the book is really focused on the high net worth to ultra high net worth client that eventually sort of evolves their relationship into one where they let the broker have a lot of latitude in how they do things. And that trust might be a little bit misplaced inside of a brokerage platform that doesn't incentivize the most efficient outcome for that investor.
And that makes total sense. We'll get to the anxiety part in a moment. Let's kind of step back to fees and let's look at Robinhood. Because right now, my 18-year-old loves Robinhood. And I'm like, son, I don't think you understand. He's like, no, I get the same price that shows on the ticker. I'm like, yeah, that may be, but you are not, Robinhood has to make money some way. They can't allow you to trade and do all this stuff for free, there's money being taken behind the scenes. Could you explain how that whole process works?
Yeah. So, I'll explain it sort of in rudimentary terms. Back in the day, when I got in the business, and I was licensed in 1985, hired in November of 84 at what was then E.F. Hutton. Back in that time period, when you would go to buy a stock, the spread between the bid and the ask was 12.5 cents. So if you were going to buy, shares of Coca-Cola, it was $40 on the bid and 40 and an eighth on the ask, and 12.5 cents was what was going to be earned by the specialist. And that specialist was responsible for being there to buy all the stock that was available on the bid side and sell all the stock available on the ask side. And they pretty much were guaranteed a very lucrative business. As digitization comes into the process, those people get squeezed and get squeezed and get squeezed some more. And then somebody has the bright idea that as long as somebody is paying a price within the spread between the bid and the ask, or no more than the ask side on a buy, and no minimal amount lower than the bid side on a sell, couldn't I just make money by knowing what that order looked like in advance? And I'll scale up a business where I'll act like a specialist, but under different rules. And so a specialist had, for that monopoly that he had to make a market in that particular security, the new version of that is a Citadel or some other firm that does rapid fire trading and pays a licensing fee to obtain transactional information before it's exited the end of the pipe, so to speak, and they get fractional second glimpses before that execution, and it allows their algorithms to run right out in front of the trade and create just enough of a disturbance for themselves to eke out a fraction of a penny. Well, somebody might say, and I do in the book, say, well, it seems a little immoral and unethical that the brokerage firm would sell access to your client information prior to the marketplace knowing about it, and the firms make money from that. Citadel makes money from that. Clients don't make money from that. But what the clients are avoiding is what used to be a 12.5 cent spread between the bid and the ask, and now that's contracted to a penny because liquidity is spectacular. I do wonder what happens when liquidity dries up and the specialists that would otherwise have to use their own money to execute those transactions. I can imagine that the rapid fire traders are going to suddenly go radio silent on the marketplace. And if under extreme circumstances that liquidity dries up, there is no real specialist like there used to be. And so in the meantime, people benefit from commissions going to zero by spreads coming from 12.5 cents down to a penny or more, decreasing the friction in the overall marketplace. So it's not all bad. It's just not what everybody perceives it to be.
Well, and so that creates flash crashes, and that creates a situation where when the market starts to fall, there's nobody there, which is kind of what was happening sometime. I think with GameStop, they were not allowing buys and sells.
That's right.
The market's constantly now got limits in to hold things, and they've put in all of these circuit breakers to stop trading when things are occurring to allow people to breathe. And I think a lot of that may have been because of what's happened in the past with certain other trades that cause problems. So we don't create a system that works perfectly. We put Band-Aids on a system whenever someone does wrong, and we figure out
that's true.
What happened and how do we figure that? Today's episode is sponsored by Profit Answer Man Podcast. Did you know that most small business owners hate looking at their financials? It's one reason they may struggle with business success. The Profit Answer Man Podcast helps them ensure they are profitable and can pay their employees and weather the storms we all have to face. It's built on the Profit First methodology of pay yourself first. The Profit Answer Man Podcast is a must listen to for every small business owner and anyone who wants to help them survive and thrive. Check it out on your favorite listening platform. So in light of all of this, you've got essentially you've got a consumer who may not be understanding all the back office of what's going on around them. What should they be looking for from their advisors? How do they pick somebody? Because when they go into the offer, I mean, they're getting a great sales presentation, but how do they know it's real?
Somebody needs to determine from the get-go what it is that they expect to derive from the relationship. Many investors go into it seeking entertainment. Now, they won't tell you that, but that's generally what's going on. So I would venture to guess that your son's love affair with Robin Hood has more to do with his feeling like he's part of the game, the affirmation that he gets from the successes, the way he digests those successes and the way he communicates about it with his friends. It gives him a topic to boast about. Whatever it is, there's some affirmation that's probably occurring from that. And if somebody goes into investing their money looking for affirmation, they're probably the ones that are going to go down the most troublesome paths. Other people look at it as, I want to maintain my liquidity. I want to create efficiency. I want positive tax results from all of this. And I want to get a decent rate of return for my risk level with the fewest number of disadvantages, and volatility doesn't necessarily bother me. I'm not reactionary. But that person right there is going to have the best results. They're going to walk away with all the money. And so it kind of depends on which camp you want to be in. If you want to be in the entertainment camp, then you need to be day trading and do whatever you find to be entertaining, or do business with a stockbroker who's going to make you feel like you're part of the game. But if what you really want is efficiency, tax efficiency, fee efficiency, and the greatest odds of a good compounded return, then you're going to choose an entirely different methodology with the way you're going to construct your portfolio and the types of pitches that you're going to buy into as to what results are going to look like if you do this or you do that. And so that second group of people is who our clients are. We don't do business with speculators. We don't speculate in our own clients' money. Our clients are already rich. I'm in the business of keeping them rich. I'm not in the business of making them rich. And so that's an interesting distinction.
And this is where I think everyone gets it wrong. They think the stock market is going to make them rich.
That's right.
But it's not about making you rich. It's about keeping you rich.
That's right.
You still got to go figure out how to become rich.
That's right. Yeah.
And I think that's a distinction that a lot of people struggle with.
Yeah, that is true.
And we'll see what happens. For my son, he does want to make his money grow. He just thinks because of his age and his exposure and at the current situation in the market, he just thinks it's easy to make money. And I'm like, yeah, I remember this. It was called 1999. It happened before.
Yeah.
And it's happening again. And
that's right.
I tell him that. I'm like, enjoy it while you can. This is not going to be a long-term game.
That's exactly right. And ultimately, his losses are going to end up in the pot that belongs to the person who's a patient accumulator. So
I don't know whose pocket that money is, because the stuff he's investing in is up and down like crazy these days. It's beyond comprehension. But my hope is, I mean, I'm okay if he loses all of his money, because that is the perfect lesson at this point in life with a small amount of money that will teach you that this doesn't work. And so I'm perfectly happy with that. In
the book, we talk about the person who normally starts out on their quest, and they usually buy a speculation thinking that it's an investment. And it can really warp the senses whether you have a vast success or a vast failure. I've seen people with vast failures who then say, oh, well, obviously the stock market game is rigged against me, and therefore I'm going to invest in real estate. Well, let's look at the math. In any particular year, the stock market goes up 81% of the time. Any 12-month time period, you go back for the past 50 years and pick an entry point. And frankly, I don't even mind if you pick the worst possible entry point. The subsequent rates of return are positive in 81% of all circumstances. If the stock market has just dropped by 10%, which is what typically gets people to thinking maybe I should raise some cash, maybe I should liquidate, maybe I should do whatever, the odds of that moment going forward are positive in 91% of all circumstances. So that just confirms that a point at which everybody wants to be defensive is the time they should be aggressive. And when you couple capital gains taxes as they currently state, you have a very strong incentive to let your money just sit and percolate if you have a broad exposure and you keep your fees and your taxes at bay. You will compound some spectacular numbers over long time periods if you just leave it alone. But that's not typically how the entertainment motivated investor will approach things, and they have no concept of how much money they're leaving on the table through their behavior, not through the marketplace.
Oh, I realize that quite clearly. I did it. So that kind of brings up the next topic, which is the irrationality of humans with investing. We are not naturally hardwired to invest. As a matter of fact, I think our very own biology makes us bad investors in the sense that when the market drops, it lights up the same part of the brain that sets up fight and flight.
That's right.
And so it makes it very difficult for us to be good investors until we overcome ourselves. Love to hear your insights.
You know, most everybody cannot learn this lesson by observing the shortcomings of other people because they never believe that those shortcomings apply to them. In the book, we state a statistic that says that 2/3 of all investors consider themselves above average. I've seen an article that said that it was 84%, but I couldn't locate that when I finished writing the book, so we had to go with 2/3. I'm not so sure that I don't believe the 84%. How easy would it be for everybody to be 84% above average? Well, it's mathematically impossible. So we tend to have a misguided impression of our own intelligence. Part of that comes from general observations in the world as to how much smarter an investor is than other people around them. Well, unfortunately, the person on the other side of your transaction is not that person that you ran across. They're typically highly educated. They might even be a professional investor. They might be an advisor like me. So the opposition in the nebula on the other side of your transaction, that person's probably going to be equal to or possibly greater intelligence than whoever it is pulling the trigger on the other side of the transaction. So gaining an advantage that way is extremely difficult when we're using our worldview as to how intelligent people are around us and then trying to apply that with the fact that the dummy that I'm buying this stock from, you know, that person's probably not a dummy. And so, and the internet pretty much pedestrianizes the flow of all this information and the ability to and this is an important point, to routinely repeat any successes is extremely difficult. And so even if you do get a leg up on somebody else from some insights and you're affirmed by that, it's only a matter of time before they get a leg up on you and you're going to find come tax time that you have to pay taxes on your profits and your losses may not be deductible. And you just have negative accretion all around. And so I think that's an observation that I would want to bring up.
And that's very true. We all think we are smarter than we are, and that some of the rules don't apply to us that right. Truly do. And I was actually reading a book on trading, which trading is different than investing, which is different than speculating.
That's right.
But the traders, I mean, they back in the day, they were in the pits and they had kind of the advance notice and they would sit and they would watch and they knew when certain situations occurred what was going to happen next. And they would just bet against it. They were looking for the suckers. And that's literally what the book talked about. You were setting yourself up for the sucker bet because it happened consistently. We as humans behave certain ways. And every time you saw the sucker set up, you knew what to do, and that's when you made your money. And the rest of the time you were hanging, waiting for the sucker situation to set up so that you could make your dollar.
One of those sucker situations that I would say is buying the dips because the people that are trying to exit during those dips, back to my 91% analogy from a minute ago, buying those dips is a very easy way to trap the suckers. People tend to start making mistakes when they start to lose money. And if you're on the opposite side of that transaction, you're going to be the winner in the bet in the majority of outcomes. And also back in the 1930s, it was illegal to trade on inside information, but the SEC didn't really start to enforce that action until 40 years later. So it wasn't until the 1970s that the SEC began to prosecute people for using insider information to trade. So for a long time period, from the 1940s to the 1970s, a stockbroker who also did business with the CEO of a publicly traded company could have a spectacular advantage by talking to, Mr. Jones over lunch and finding out that they were going to buy XYZ or they were going to do this or that. And with reckless abandon, he could go back to the office and apply that knowledge to his other client accounts. Over time, when the SEC began to prosecute that advantage was just sort of vaporized overnight. That also coincided with the deregulation of commissions in 1973 or 74, where the regulated commission environment of doing 1,000 shares of some $100 stock might have been a $900 commission. Charles Schwab might be able to do that back then for $50. And then it went to $20, and then it went to $5, and then now it's gone to zero. And so the whole process has gotten very pedestrianized and generally to the advantage of the investing public if they don't go about it the wrong way.
One of the things that has also changed is big data. And I don't think people realize how much money is put into this and in watching. So, for example, there are companies that will buy satellite data that are watching Best Buy parking lots. They're counting cars. Like, that is because you can't do insider trading. They're doing outsider trading, right?
That's right.
They are watching those types of data points to be able to make better choices.
And I think the lesson from that is not the value of the data, but that the process is getting further pedestrianized by the existence of that data. So what that tells me is that once somebody subscribes to the newsletter about the Best Buy parking lot data, then the next person calculates the registration miles and the amount of fuel and whatever. I mean, take it to the nth degree. Once you mechanize all that with artificial intelligence and the like, you might have a very small advantage for a very short time period until somebody else figures out what you're doing and they begin to exploit the same thing. Then that's just going to cause you to have to go to layer number 2, layer number 3, and the process gets more and more efficient with each one of those layers, robbing the advantage out of whoever invented it, and eventually their advantage is going to dissipate. And if you think you can produce long-term compounded returns from that type of moving target, you are sorely mistaken.
That's why you don't put it in a newsletter. That's why you keep it to yourself so nobody knows how you're making money. If it's in a newsletter, it's too late.
That's right.
And it's only designed to make the newsletter writer money, not to make you money on your side. And that's it's another one of those ahas that you have to be aware of and to realize. So let's talk about current market conditions, because we are in essentially unprecedented times. Stock market, all-time highs, bond market, interest rates, all-time lows. You've got these new cryptocurrencies that are going crazy. You've essentially got frictionless trading in the sense that it costs nothing to make a trade. So there's not even a thought of having to spend $1 to make the purchase, so to speak. And we have a Fed that's printing money faster than it's ever printed.
Well, you bring up some interesting points. You would think that the Fed printing money would lead to inflation, and you would think that that would cause rising interest rates. That is starting to happen. Interest rates had some violent moves upward latter part of last year and first part of this year. I get spooked because, in the 37 years I've been in the business, interest rates have generally been declining the entire time. And people don't fully understand how that prepares a tailwind for almost all investments. When interest rates were 9% for a CD and then you were offered 8, well, maybe you would renew, maybe you'd buy some shares of General Electric. And then when interest rates went to 6%, maybe you would renew your CD, or maybe you would buy some Microsoft, whatever it happens to be, or real estate. And so the backdrop of declining interest rates robs people of a fixed return from a safe money investment. And here we are with the 30-year Treasury at 2% or whatever the number it is. People also lose sight of the fact that interest is fully taxable, where dividend income off of equities is taxed at essentially half that rate and can be accumulated, not the dividend income, but the return from the corpus can be accumulated tax-free if you hold it for a lifetime. And so once people begin to grasp how taxes work and how that affects long-term compounded returns, I think they would change their investment policy. And I think they also will come to realize that sooner or later, when interest rates begin to spike, people are going to be selling their shares and they're going to be buying the 6% rate of return. Although you would think that would have happened, I thought it was going to happen back in 2008 when we had our first big round of Fed ease. It just never materialized. So there's clearly something about the process that I don't understand. And we also would have thought the same thing would have happened in Japan, because they've been pressing interest rates lower for 30 years, trying to get their economy out of the doldrums, and they have yet to be successful. I remember in 1988 or 89 when they were buying California real estate left and right, and we all thought that they were going to end up owning the whole country, and then poof, it all just kind of vaporized, and then they've had no growth. And so I don't really understand all of those workings, but I am fearful that the day will come when we have rapidly spiraling upward interest rates and the negative effect that that's going to have on equity prices.
And I think that's what people need to be aware of, is that it is a considerable issue and that it is going to cause trouble going forward.
Yeah.
And the tailwind that it has caused over the past is definitely something to be aware of. And one of the things that I'm always constantly watching, but as I've come to learn, is what I think is going to happen doesn't necessarily happen. And so I've got to start watching the trend instead of what I think is going to be the next steps. I will say this because I work with a lot of small business owners. The one thing that I'm hearing coming back, which has not been something that's talked about before, is wage inflation.
Yeah.
And wage inflation seems to be significantly picking up. And it's picking up because people have a choice between unemployment somewhat or a hefty amount of unemployment. Part of it is some of the larger companies like Amazon have set some pretty high rates for their workers, and it's putting pressure on the entire system.
And this $15 minimum wage thing that keeps coming up will also put upward wage pressure on inflation. But, you do at that same point in time have a great incentive to start building robots to do all these things. And the technology does exist to produce those. The kiosk at a McDonald's to no longer pay an employee to take your order, that's a very real risk of these $15 minimum wage requests. So, I don't really know how it all plays out, but I think we're in some dangerous and unprecedented times. Part of the reason why I think you also have not seen wage inflation over the past 20 years or so is that the power of unions has been decimated, and unions their sole purpose is to disproportionately favor higher wages in an economic system that favors equilibrium. And that being the case, the weakness of those labor unions has been a source of why you've not had wage inflation, and you've had a burgeoning economy that has favored financial assets, because that would also favor corporate profitability. So, but I understand why that would harm the person at the low end of the economic spectrum and help the person at the upper end. So I don't know what's right or wrong. I just, kind of see some of the warning signs on the wall.
Well, and I know in our local supermarkets, even Costco now, half of the checkout traffic is self-checkout.
Yeah.
With one person watching 6 registers instead of 6 to 8 people working the registers. So that's going to continue to happen over time.
Absolutely. Yeah, which is an incentive to develop skills. And the incentive to develop skills has always been there. And that's part of the problem with the safety net, is that you disincentivize people from the desperation that we were talking about earlier about how we deal with our kids. That same desperation that says, oh my gosh, if it is to be, it's up to me. That's what causes people to get retrained in new businesses and to think about, maybe I need a better education, maybe I need to develop more skills. All of that is part of the economics. You know, a minimum wage job is not designed to feed a family of 4. It's a transition into the panic mode of, oh my gosh, I better do something more with my life. And, you know, without that hand spanking, I don't know that our economy is going to be helped by forcing higher wages into lesser skilled employees.
You know, it's funny. When I was growing up, they would always say, eat all the food on your plate. There's a kid starving in China. And as my kids were growing up, I'm like, study harder. There's a kid studying harder in China. You know, the world has changed. You know, they're competitive now. They're not starving anymore.
Yeah. So
that kind of brings up this last subject. Everyone has gone to the idea, and it's been promoted by Jack Vogel and Vanguard, of going to index funds. And I get it. I understand the concept of index funds. I understand, hey, it's a lot easier to just bet that there's going to be a winner in the race than to figure out which one's going to be the winner.
Yeah.
However, as part of that, people are just plowing money into every company without regard. And does that kind of create some sort of systemic risk over time where certain stocks are overvalued simply because we have to buy them as part of the index?
Yeah, there's a risk of that. But you would think that if indexation were so widespread and facts and values were so overlooked, that in fact exploitable opportunities would be more manifest in that kind of an environment, creating a pathway for active management to suddenly have a distinct advantage. And that does tend to ebb and flow. I'm just of the opinion that the two disadvantages of active management can never be outrun. And that is the extra cost that you have to pay for it, but even more so, the tax friction that's created by the existence of that. And indexation is brought to the next level in the ETF structure, which we also get to this in the book. And that the very structure of an exchange-traded fund is different than the structure of an open-ended mutual fund. And that structure has very profound tax advantages for long-term holders. As you know, if you ever own an open-ended mutual fund and not in an IRA, you're going to get a 1099 and you're going to end up having to pay taxes in the vast majority of all years. And that's going to adjust what you technically paid for the fund. It's really just what you paid taxes on. And through the years, you'll find as your dollars advance and advance and advance, your tax basis is going to follow up your current market value, and you're not going to trap a difference that you can exploit through charitable giving and other things that ETFs and individual stocks would allow you to retain. And compared specifically to an ETF, it tends to maintain its original cost, irrespective of the changes in market value, and you end up trapping a wider and wider profit spread that under current rule would be tax forgiven at the death of the first owner, or ability to give it tax efficiently to a charity and take a tax deduction for the entire amount and avoid the capital gains treatment. So anyway, those are advantages that ETFs have that I think if Mr. Biden gets any of his tax proposals passed, the advantages of an ETF are even going to be more profound. And it's going to make people think about their transactional methodologies and try to buy a position for the next 30 years. And they're going to settle in on why an ETF is a very efficient way to position your money that way.
Makes a lot of sense. We've covered a lot of ground today. We always like to end with an action step. What is something people can do this week to kind of move forward?
I think a good dose of introspection is good for every investor. Back to our point about what is it that you're trying to derive and why are you trying to derive it? And if it's serving the ego of I'm trying to do this to make me feel good, you're probably barking up the wrong tree. That type of an emotional response to what you're trying to develop as investment policy is normally going to put you in a position to be self-defeating in some form or fashion. And if you're really just trying to efficiently accumulate more wealth through an unknown outcome, you're probably going to be more embracing of tax-efficient occurrences, low-cost occurrences, and streamlining your portfolio and embracing the unpredictable nature of the future, knowing that it's pretty darn predictable over long time periods, and focus on the long term and not, what advantage can I gain over my buddy at the golf course so that I can brag about it on the next tee box.
It's a lot easier to hit a target when you have defined your target.
That's exactly right.
It's time to learn the secrets of life. What's your secret to living an abundant life?
Recognizing that the world is bigger than just me and that I need to get gratitude and my sense of self-worth other than accumulating more net worth for myself, and embracing what changes I can make in other people's lives by being generous with my time and my resources.
It's funny. They used to think that the universe revolved around the earth, and they found out that wasn't true, but people still think the universe revolves around them.
That's exactly right.
What did you learn later in life that you wish you would have learned sooner?
I always thought that I could trade my way into an advantage. And it wasn't until I became much more objective about my faults that I really began to see what a deleterious effect my mistakes had made in the past, because I would tend to focus on my prosperous gains, and I really never did the math on what the net effect of that was, and I would have been way better off to have been less transactional and less pompous in my approach to how much smarter I was than everybody else.
And understanding that is a big part of understanding the way you invest, is to understand who you are as a person, and also understanding how you're going to freak out or what your biases are so that you don't put yourself in a situation that they harm you.
Well, when we interview new clients, we put them through a little bit of a Q&A, and what we're really testing for is what their mettle is. And when somebody says arbitrarily, oh, yeah, I can experience a 20% decline, I know that comes periodically. Well, I'll tell you what, you give me a $4 million account and I lose $800,000 of it, and your perspective on that's going to have a very different effect when we're talking about what 20% of $4 million looks like. And so I make them experience that hypothetically. So you get a statement that says it's worth, $3.8 million, you're down $200,000. How does that feel? We go through that because that takes away the arbitrary nature of 20% doesn't sting, but 800 grand does.
You got to put it in numbers.
That's right.
If you were to give an 18-year-old one specific piece of wisdom, what would it be?
I would say it would be to look at your investments from a total balance sheet methodology. I find young people love to borrow money and then disregard that on their balance sheet, and they look at their $50,000 brokerage account and pound their chest as to how wealthy they are, completely not realizing that they have $50,000 worth of accumulated debt on their credit cards that they're being charged 18% on, and the car that they bought on leverage, they borrowed the money, and it's going to depreciate. So another insight that goes with that is don't borrow money for a depreciating asset. Borrowing money for a house, that's fine. Borrow money to start a business, that's fine. Borrow money for anything that will prosper you. But when you borrow money for a vacation, oh my gosh, the math on that is terrible. You borrow money for a motorcycle or a car or whatever, that needs to be paid for with cash. And so that would be the insights that I would give to somebody young.
You know, it's funny. I started adding a new line onto my rental applications, which was, how much student loan debt do you have? Because they didn't even consider that debt. And so I will challenge people today to say a diploma is probably a depreciating asset.
Mm-hmm.
And so consider how much you're borrowing for that enormously expensive depreciating asset, especially if you're going to spend your time partying.
Agreed.
It's a big price to pay. If people would like to find your book, find you, learn more about your services, what's the best way for them to do that?
If they're looking for the book, the best place to go is to either gilbaumgarten.com, GilBaumgarten, gilbaumgarten.com. My business website is Segment Wealth Management, so that would be segmentwm.com. They can also sign up there for my blog. I write a blog about every 3 weeks about how all this stuff works. Many of the topics that we've just talked about are covered in my blog, so that would be segmentwm.com/blog, BLOG. Or you can go to Amazon to buy the book, and the name of the book is Foolish. If you put in Foolish Baumgarten, Baumgarten, the book's going to pop up. It's a yellow cover with a ladder on the front of it. And read the book and, subscribe to my blog posts and call me if you have any questions. I'm in Houston, Texas.
We will put that all into the show notes as well to make it easy. Thank you so much for joining us today.
Glad to be here.
What actions are you taking to improve your financial situation? Are you doing anything to build grit in yourself and in your family? Money isn't easy, but it doesn't have to be hard. Figure out a system that works for you and takes very little in fees to run. That's the key. The fees, many of which you don't even see, can totally derail your progress. This week's action step, a good dose of introspection is good for every investor. This is really important. You need to understand how you behave. Down markets and up markets mess with our emotions. We get scared or we get greedy. Having an exit plan when you enter an investment helps you to think before your emotions gets the better of you. Most people don't take the time to understand how they react to financial challenges and create those exit plans. Also, be careful who you get financial advice from and understand their incentives behind their behaviors and what they have to gain. That will help you understand why they hold the position they do. Next week, we have on Chris Michael Harris to chat about the entrepreneurial journey, but it is so much more than that. It's how to live in peak performance. Stay tuned. If you enjoyed today's episode, please share it with a friend or post it on social media. I'd appreciate that. Thanks for listening. Have an abundant week.